Good morning, ladies and gents. Thank you so much for joining us this morning and welcome to the Global Private Banking Innovation Summit. My name is Nirav Patel. I am the Managing Director of Global Private Banker and the Digital Banker. For those of you who may be unfamiliar with our organization, we are a market insights and news publication to the worldwide financial services sector. And every year under the Global Private Banker brand, we put on an awards program which really looks at assessing the best-in-class private banks, asset managers, family offices, those that are sort of driving innovation across all facets of service, advisory and products. I'm very delighted this morning to be joined by an exceptional lineup of speakers. Today's session is two parts. We'll kick off the morning with the CIO Morning Bell, which will bring together some notable investment strategists from leading private wealth organizations. We then move on to our Private Banking Leaders Digital Symposium. So without further ado, I would like to introduce the first panel. And on here we have a number of speakers. So this is a very broad topic. And of course, there is a lot to discuss. So I'm going to be as short as I can in my introductions. As you can see, the first speaker that we have is Adrian Zucker from UBS. And Adrian is the head of global asset allocation at the UBS Chief Investment Office. He has been so since June 2020. And Adrian's also responsible for the multi-asset portfolio solutions. He joined the bank as head of asset allocation APAC in May 2014 and was responsible for the APAC asset allocation strategy for both discretionary and advisory mandates. Over to his right, you'll see Alexander Wolf from JP Morgan Private Bank. Now, in his role as head of investment strategy for Asia, Alex is responsible for developing and communicating the private bank's view on the market, economy and geopolitics for investors and clients in the Asia region. Prior to joining JP Morgan, Alex actually held senior positions with Aberdeen Standard Investments and the US government state and defense departments. Alex is going to be joined by James Chio from HSBC Private Banking. James is the Chief Investment Officer of Southeast Asia at HSBC Private Banking and Wealth Management. He has over 15 years of portfolio strategy, asset allocation, and economic research experience. He's actually spearheading the development of product fulfillment strategies across all asset classes for clients in Southeast Asia. Also join me in welcoming Prashant Payani from BNP Paribas Wealth Management. Prashant joined the organization as its Chief Investment Officer Asia in January 2016. Earlier to that, he was a senior global investment specialist for JP Morgan Private Bank. His other senior appointments were at Goldman Sachs Asset Management and Chase Manhattan Bank. Interesting fact, he also co-founded Cork Street Capital Advisors, a global equity alternatives firm based in London. I'm also going to welcome and dialing in from, I believe it's Frankfurt, is Juan from the Deutsche Bank International Private Bank, and Tuan is the Chief Investment Officer for Europe and Asia. He's currently based in Germany. He is responsible for the distribution of the house view. So prior to this role, he was the Chief Investment Officer and Head of Wealth Discretionary for emerging markets based in Singapore. And finally, I'd like to introduce you to your moderator for the CIO Morning Bell, which is Praveen Ravindran. He is the founder and CEO of Asset Co, and he will be moderating this panel. As I mentioned, a lot to go through. I'd just like to say a very warm thank you to all the panelists on this forum. Most of them actually contributed to our Q1 CIO Insights, which is a quarterly briefing issued by the Global Private Banker. If you look and turn your attention to the chat function, we will actually provide a link where you may download this briefing. It's fairly in-depth review. I'm now going to pass you over live to the panel and let the moderator take it away. So Praveen, over to you. I believe we're still waiting for Adrian, so just bear with us. We'll try and get him on, but Praveen, I'll pass the floor over to you.
No, absolutely. Thanks, Nirav. It's a pleasure to be chairing this session today. So we'll get right on to this. So as one of the most talked about subjects in the recent weeks, there have been polarized opinions on inflation. The Fed says inflation is up due to transitory factors. However, a lot of experts are of the opinion that the Fed is underestimating the risk of inflation. Now, according to a doom perspective by Nouriel Roubini, which is on the extreme side, we are left with the worst of both the stagflationary 1970s and the 2007 to 2010 period. So posing the question to the panel now, is inflation here to stay or a transitory phenomenon? Prashant, let's start with you.
Sorry, you can hear me?
Yes.
My panelists, fellow panelists, and I have never heard the word so much transitory as much as we had in the last 6 months. But the key is that what's interesting is we're not in the hyperinflation camp, we're in the reflation camp, and that's how we were positioned. So we have U.S. inflation at running above 3% this year, 3.9, so well above the Fed's target, and still above the Fed's targets next year at 2.7. So above trend inflation. But as you look further out, next year fiscal stimulus lessens. It becomes a headwind, actually, notably in the US. And actually, inflation pressures are really much more paramount there than in Europe, where they're much more muted. It's still at this point of the cycle. And secondly, the wild card, the transitory factors, used car prices, lumber prices, which now have really come down. Commodity prices still well up year on year. But when we look at the more permanent factors and the inflation expectations, those are still relatively under control. They've increased, and they should. 5-year forward inflation expectations, peaked at 2.5. Now they actually come down a bit, and 10-year yields at February lows as of last night. So we've seen a little bit of a flattening of the yield curve, which means the Fed right now is still in the sweet spot where we're seeing higher 2-year yields, but we're seeing lower 10-year yields. So they believe that longer-term inflation expectations are still under control. If those pop above 3% materially and stay there for a number of quarters, out 5-10 years, then we would have to reconsider that view. But at this point, ironically, the market's actually moving the other way a little bit.
Thanks, Prashant. Tuan, what's your view on the same topic?
Yeah, I think what Prashant just mentioned is somehow our view at Deutsche Bank as well. And I really don't also want to use that word transitory, but I think it is like it is, especially when you also look at some of the components. Prashant mentioned it, the used car price. We all know why it is jumping up because of a shortage in semiconductors. And I think this will not be there to stay. And of course, we also have to consider the fact that last year, the base effect was pretty low, right? I mean, if you remember 12 years back in April, May 2020, basically the whole world was standing still. And hence, of course, the comparison level is rather low. If we look forward the next 12 months, so in May, June 22 compared to this year, of course, the level has already moved up. So hence, we don't think this kind of 4 or 5% level will be there to stay. So similar to Prashant, our view is also inflation will be or will come back and will stay above trend, but definitely not in that kind of range of that 4 or 5% we are currently seeing. So we are also in that camp that, of course, this year inflation will be maybe reaching that 3% kind of level, but for sure will trend down next year. So hence, I think if you look at current market expectation, both on the inflation side, but also reflected here in longer yields, we are already coming to a level which is lower than we have seen before this inflation number come out. So I think the Fed this time has prepared the markets pretty well, I have to say.
Okay. Thanks, Tuan, for your feedback on that. Alex, just taking it a step forward, of course, I would definitely want your opinion on this. But in addition to that, what do you recommend investors to keep in mind when it comes to asset allocation, keeping in mind your view right now of inflation?
Sure. I think starting with the inflation point, We are very much in line with the previous two speakers. I think I won't really mention the T word, but we have been using that quite frequently over the course of this year for all the reasons that have been stated. I think when you mentioned semiconductors and you mentioned auto prices, when you strip those out, because those push up the mean, they push up the averages. So the headline inflation rate, when you strip those out and you just look at the median is still quite within the Fed's range. And of the forces that tend to drive inflation, you can really narrow it down to wages and rents as the two key factors. And rents have fallen quite a bit. They'll climb in line, perhaps slightly with housing prices, but we expect them to not be significantly inflationary, and with still a lot of labor market healing yet to occur, that wages will not present upward pressure. And right now it's difficult. It's just very noisy. It's just, we're coming out of a pandemic. There's a lot of supply demand mismatch. There's a lot of issues with the labor market and unemployment benefits. And so it can be very hard to get a read on it, but we do think it very much will settle down. I think from an asset allocation perspective, over the course of this year, we have been very favorable on kind of broad reopening and reflation and cyclical ideas. We have been above consensus from a U.S. growth perspective, above consensus from a global growth perspective, and so we very much have favored equities relative to debt, which I'm sure is quite consensus. We within equities, we have favored, like I just mentioned, cyclicals. So we're looking at industrials, materials, energy broadly. We now see the world moving a bit from early cycle to mid cycle. So I think the easiest gains are behind us. So it's more about alpha versus beta, so to speak. So we are looking more from an active management perspective, from a hedge fund perspective, and just being more selective as well. And now looking at balancing between cyclicals, say, and some of the growthier parts of the market like tech. Whereas before we were really focused on cyclicals, we're looking at balancing the marginal investment dollar, so to speak, going forward, just based on where we are in the cycle.
That's really interesting. So James, on the same line, definitely want to know your view on exactly what your stand is around inflation, and then what would you recommend in terms of asset allocation for investors around the world?
Well, I think it's very important to take sort of a long-term view. To have hyperinflation in the system is actually extremely rare if you look through history, and you really need a kind of a perfect storm to occur, like in terms of wage price pressures that's uncontrollable, that whole wage price dynamics that goes on. And of course, the spark back in the 1970s was really oil prices. This time round, a lot has to do with temporary factors because pent-up demand is so strong, and of course you get supply bottlenecks as the economy reopens, and that's why we are seeing inflation right now picking up. But I think it's true, I agree with all the panelists here that inflation would start to stabilize going into 2022, because that whole growth momentum that we are seeing so strong this year would likely taper next year. And because of that, inflation pressures would actually also subside. So I think because of that, what one would have to do is that in terms of asset allocation, you have to think and frame up in scenarios. I think currently the base case is things are under control, but of course, you can actually get some inflation pressures, inflation reading in the next few months. It's going to be volatile. You want to put on sector exposures to, let's say, reflation trades, maybe even with the dip in 10-year treasuries now, you might want to look into financial sector that can actually do well if bond yields start to back up again. And of course, you want to look into some inflation hedges, whether it's gold or some of the commodities that can actually do well. So I think that's how one should think about inflation. Should not be too afraid of it, but be prepared for it.
Okay, thanks for that, James. Now, you did mention about investing into different things. Now, you also mentioned about gold. I'm going to just bring up this topic because there are a lot of HNWIs attending this session, right? So there has been this consistent trend this year for a lot of people to for a lot of investors to consider digital gold investments in as compared to physical gold investments or investing into gold as a commodity. So digital gold meaning investing into cryptocurrency. That interestingly, a lot of people have been using the word digital gold instead of cryptocurrency nowadays, and consider that to be an alternative. What's your view around that? Do you think that is the right thought process, replacing physical gold investments with digital gold, or that there is a requirement for a realignment of thought process around this, around cryptocurrency investments?
Well, I think to put into perspective, first and foremost, the whole crypto complex is extreme. There are thousands and thousands of cryptocurrency in it. And even the most popular one, Bitcoin, is extremely volatile. And as of now, I don't think they exhibit the characteristics of gold, which has been around for thousands of years. In that, even in financial markets, what gold does is a portfolio diversifier. So if risk assets go down, the value of gold holds. And I think cryptocurrency in general, Bitcoin, does not exhibit that as yet. So I think it's too early to have that sort of substitution effect. But I think it's hard to tell what's going to happen in the future. But I would view cryptocurrency, especially the blockchain technology, as something that is an emerging innovation rather than a kind of a safe haven sort of portfolio diversifier at this stage.
And Samuel, thanks, James. Adrian, we had a quick chat about this, and I believe that this is a question that has been posed by some of the investors to you. So I wanted to know your opinion as well in regards to this. Do you think it's the right thought process around replacing the investment into gold as a commodity with the Bitcoin and being Bitcoin called as digital gold, or not?
Sure. I mean, let me first say we're not big fans of gold particularly not at the moment, but we also don't have it in our strategic asset allocation. I think gold has a very low expected returns over the next 10-15 years for our capital market assumption, but actually almost equity type of volatility. So the safe haven argument, we're not buying from a volatility perspective. Of course, during some periods of stress, gold can do well, but also gold is actually a very poor inflation hedge. It's a play on real interest rates, but inflation itself has actually little correlations to just the inflation part itself. So from this perspective, we actually see gold much lower from the current levels. So we think it can go even back to 1,650 over the next 12 months, as we do think that real interest rates will start to increase over the next couple of months, as the Fed probably sort of is at the inflection point where they will start to taper, and inflation, we actually think it already peaked. Will come down as well, so the real interest rate side will actually become less attractive for gold. Now on the crypto side, I think there's definitely a lot of interest for our clients. We don't have it in our portfolios at this point, but I also think the view to compare it, as you also have heard, is probably a wrong approach, in the sense of, first of all, crypto is talking about Bitcoin in particular, is much more volatile than gold. So we're talking about a volatility of around 40% in crypto, which is really a speculative asset at this point. And the other part is, if you look at correlations, it's flat basically. So there's no correlation between gold and Bitcoin, and this will tell you it's definitely not a substitute. It's maybe diversified to gold from a correlation perspective, but it's probably a bad substitute. And therefore, we are very, very cautious at this point on cryptocurrencies itself and Bitcoins. If you want to have some exposure to this new technology, and maybe it's sort of something that will evolve over the next couple of years, we're not against it, but we definitely will not hold it in our portfolios.
Thanks, Adrian. Now, moving to another topic from inflation. So China recently celebrated the 100th year anniversary of the Communist Party, where Xi Jinping had expressed his strong opinions about China's relationship with the West. This week, with the current restrictions placed on Didi by Beijing, Didi has become one of the recent casualties of relationship deterioration between China and the West. I mean, this is what some of the experts do comment on. The new administration in the US also comes with its own perspective and threats to the current relationship that China and US has, and even the whole West has to China. Now, of course, all of this would have a severe impact on what you invest into and the favorability of emerging market focused investments over developed markets. So on that note, I just want to ask you, I want to go for this question with you, Tuan. How to what extent do you believe that at this point of time we should be looking? I mean, there should be an increase in asset allocation into China-focused investments as compared to the developed market investments in the short term, and what's your perspective on how that would evolve on the long term? And then after that, we can go to the rest of the emerging markets.
Sure. So I think just simply from the fact that the Chinese equity markets will play a bigger role and has already played a bigger role in global indices, this will force money manager like us to have a bigger share of the Chinese equity markets in their portfolio, and especially those who are then managing according to benchmark. So hence, this will naturally increase with the size of the Chinese equity markets. Coming back to your question, of course, we have seen over the past couple of years, starting, of course, with the Trump administration, that there has been some conflict between, especially the US and China. It started, of course, with a trade conflict. Now it goes over to a more political and also, of course, when it comes to technology kind of question. So to me, over the next 10, 15 years, it's more a question of the battle of technology leadership. We know that both countries are putting a lot of efforts to kind of maintain their current status, to become less dependent from the rest of the world. We discussed already about the shortage in semiconductors. There are, of course, ambitions to here strengthen their own technology, and China, as we also have heard recently, put it in their last 5-year plan to become an even greater leadership here in technology. So to me, over the next, I would say 10 years, that will be the battle between these two giants. Unfortunately, as I'm now based in Europe again, Europe is kind of falling behind. All the companies we were discussing or were in the leadership 20 years ago are either non-existent or have already get out of the market. So I don't think Europe would be able to close the gap here between the two big players here. So hence, to me, it's only between the US and China. So hence, I think this will also be expressed in a higher asset allocation, higher share of the Chinese equity markets in global portfolios, but for sure also in global equity portfolios.
Thanks, Joanne. And as a follow-up to this, because investing more into China means there is also a direct impact on that in allocation into emerging markets as a whole as well, with the neighboring countries and investing into the neighboring countries as well. So are you implying that there is going to be a definite growth on long term to emerging market investments as compared to developed markets, and there is going to be a lot of flow going from developed markets to emerging markets on the long term because of this, because of China's growing power in the global stage? Is that the recommendation?
Absolutely, and I think this has already taken place. So if I look back at, let's say, how our asset allocation were about 10 years ago, and today, obviously the share of emerging markets in a global portfolio context has more than doubled. Of course, from a relatively low level, I have to admit, So hence, if I look forward the next 10 years, I would think that could be another level of increase of emerging markets. And here, of course, within emerging markets, we are clearly talking about the Asian markets here, and within Asia, it is clearly than China. And hence, I think this will play a much bigger role for all investors. And I can also see this here from European investors that there is a ask for an even higher emerging markets / Chinese share here in their portfolios.
Thank you, and thanks for that, John. Prashant, coming back to you, I would want your opinion on the same topic, and I want to know: are you do you also have the same belief that on the long term there is going to be it's eventually going to happen that the portfolio allocation is going to grow into the emerging markets as compared to developed markets?
In short, yes. When you construct a portfolio, clearly China's weighting, both in the fixed income and the equity market's going to increase in the next 3 to 5 years dramatically. So what that also means is more fund managers meeting Chinese companies and hopefully better governance and other standards over time as well. It improves return on capital. Key challenge for China is improving return on capital in the next 3 to 5 years. They want to come out of middle income, be an innovation economy, and reach middle income and beyond. And that's the way that you do it. So that's really what the focus will be on. But in terms of the deglobalization trend, that's going to continue. It's not just US and China, it's Europe and China. And in selected areas for a variety of reasons, national security, there'll be some deviation. But we're not going to completely unwind what's some of the globalization supply chain, but clearly there's going to be more localization. But when we look at our long-term capital assumptions for EM, return and risk, it's actually higher than the US. The US equities have handily, as we all know, outperformed other developed markets and EM the last 10 years. So our beliefs, there is good opportunity in the medium term for EM. Clearly there are cyclical pressures as well at times. And then finally, I'd say when you think about Biden, it's just a continuation. It almost feels like Trump with a smile, but it's much beyond that. It's using multilateralism. So he's partnering much more with Europe, Japan, Australia, and other regions. So this is a broader political issue, but the economic issues, China's stock market is largely domestic in revenues. It has almost, if you look at local China shares, percentage of revenues to the US export is very low. So really the dual circulation by President Xi, the consumption strategy domestically, and the transition to middle income is what we're looking at.
Right. Thanks. Thanks for that, Prashant. Alex, your opinion, is it similar to the last two panelists, or do you have a different view on this?
I'd say it's slightly different. I think in the respect that we increasingly see China as worthy of a standalone allocation, separate from the rest of EM. And I think for all the reasons that recently have been highlighted, of course, as China somewhat decouples both from a technology perspective, but I think even broadly, you see that the economy, just like Prashant pointed out, it's more domestically driven, and it's less correlated both from a policy cycle and a growth cycle. So you're getting some diversification there from China, but as well, we increasingly see the world from a tech and innovation and productivity standpoint being driven by these two poles, essentially China and the US. And then in addition, China's just sheer size alone, I think, necessitates a separate standalone allocation. But when you think about the rest of EM, I think long-term capital market assumptions is something that's interesting to mention, because I mean, we do them at JP Morgan, most asset managers do them. But if you look back over the past 10 to 15 years, most long-term capital market assumptions for EM have been way off, particularly say EMX China. And EM, the way I tend to look at it, it's more of a tactical position versus a structural position. It does well when the dollar is weak, commodities are up, when the EM-DM growth differential is widening, and when trade is then naturally strong as well. But it's hard to make a structural case for EM ex China. You don't really see productivity increasing dramatically. You don't see reforms increasing dramatically. It's hard to make that long-term structural case. And then on the back of that as well, you haven't seen earnings really either over say an extended period of time outside of China. So we're increasingly looking at China as almost separate from EM, and then we look at more of a tactical case for EM just based on where we are with global conditions. But but don't think that China really is driving us to take a more positive view of the rest of EM. We're just looking at it as a separate allocation, more or less.
Okay, all right. So you're of the belief that just like we have had Asia ex Japan for the past decade or so, we should have EM ex China as an investment region.
More or less, yeah.
Okay, all right. That's good. And Adrian, do you have a differing view or quite similar to Alex?
Well, I think, I mean, I have probably two cents on this side where I don't want to say we differentiate, but one point is China definitely has become a very important investment topic, and if you include it in EM or you have it outside, it's the one that is driving basically the whole EM story. We give actually our clients the choice basically. So in a global portfolio, we sort of stick to sort of an MSCI weight, have a bit more emerging market, as we do anticipate that China will grow in the global index. But we run already portfolios with a 50% Asia/China bias, and there's a 50% global exposure. So clients can actually choose basically which portfolio they would like. And we see definitely a shift, particularly also from European investors that want to allocate more to Asia, and they're happy with having 50% in the region. On top of that, and that's probably also on correlation side. So the really interesting part on the correlation side is onshore China. We are running 100% onshore multi-asset class China strategies and portfolios in the onshore business for our onshore clients. And we now see more interest from offshore investors to tap into this knowledge and to tap into these strategies, because they're actually the true diversifier to global portfolio. And we're always talking about equities, but I think even the more interesting part in the low interest rate environment is actually onshore bonds, starting from government bonds, which we already allocate to our global portfolio. So we replaced US high-grade bonds with onshore bonds, pays you roughly almost 200 basis points of yield pickup. We still do like the currency. It's definitely something we have to monitor. So we're still sort of in a bearish US dollar stance currently in our strategies, but probably over the next couple of months, this will become a bit more differentiated, as the Fed probably will be the first major central bank to sort of start to taper, which could give a bit of tailwind to the US dollar. But the fixed income side, with all the issues that's happening currently, but it actually offers a very interesting diversification to a global portfolio. And that's where we start to allocate already now more, and we want to have this onshore exposure on China.
All right, thanks. Thanks for that, Adrian. Now, I just want to, because Alex had a differing opinion on this, I want to just ask Prashant, from at your end, what would you consider the same opinion about emerging markets being considered separately as to China, or?
Yeah, I mean, there's a disparate group of countries. So a lot of countries that depend on commodity prices. There are other countries that are linked with North Asia. So we very much look at North Asia together, China, Taiwan, South Korea, because of some of the technology issues we earlier spoke about as a block. But large domestic consumption economies like Indonesia, India are different. And India is possibly being overlooked globally and in the medium term, because China's population is aging, trend growth of GDP is going to slow. If you think about China's weight in terms of percentage of global growth, exposure to the world's growth, that will probably decline going forward. So we're moving to a multipolar world as well. So, but yes, we do look at North Asia differently from other parts of Asia, but also other parts of EM.
Okay, so you would combine the whole North Asia together, and Tuan, your perspective on this?
Yeah, I mean, when we look in the emerging market space, of course, we know Asia is quite the dominant player here, and within China, within Asia, as I mentioned before, of course, China is the obvious biggest part of it. And as you rightly mentioned, we have been managing Asia ex Japan for a considerable period of time. So maybe the next 1 or 2 decades, we really have to talk about Asia, maybe ex-China. And China, I can imagine, could become then a single asset class or single country comparable to the US and Europe, because also of just the size, not only of the economy. We know China will most likely be the biggest economy in the world in this decade already, and hence also the size of its capital markets will also surely increase. So hence deserve here a consideration to be stripped out. So we are moving in that direction more and more, but haven't really put that in place. But I can imagine in the next 5 to 7 years, China could become a single region, both in terms of fixed income, but also the equity space.
Thank you, and thanks for that, Tuan. And James, a slightly different question for you, because I know that you had specifically highlighted around the green initiative of China as well, and there was of course there's a lot of content around the fact that the green initiative that China has is going to be one of the very few policies at the recent times that West would want to collaborate with, and could be a starting point for the collaboration to go in the positive direction. So my question to you is more about the green initiative, and do you strongly believe that is one of the starting areas for positive collaboration with the West, and how is that going to change the way in which ESG is even looked into in this region in Asia by investors in here, with China's strong perspectives around this?
Well, I think China's carbon neutrality plan is actually extremely ambitious, because they are at this stage the largest carbon emitter. But of course, if they want to become carbon neutral, they have to go really big on in terms of this whole energy transition in their whole system, to shift from coal producing to largely renewable energy. And that's going to be a massive shift. It's going to occur not just on the energy sources, but also on the transportation system, where there's going to be much more usage of electrification of transportation system, whether it's in the cars, trucks, etc., and also to use new technologies such as green hydrogen. And of course, even in their urbanization push, there must be employment of smart buildings, energy efficient usage, etc. So this whole shift for China, as they want to go into this sustainability drive, this whole green revolution that China is going to and plan to embark on, is going to be one of the game changers in the years to come. But of course, the road ahead is still going to be fairly bumpy, and there are strategic reasons for why China wants to do this. I think for one, it's also because the country actually experienced quite a lot of air pollution. For those who live in Beijing, you remember that air pollution is an issue, and they want to solve all these problems internally as well. But I think ultimately also, if they go on to renewable energy, they will reduce reliance from the rest of the world in terms of oil or other commodities, and therefore it also improves the strategic position if they go into renewable. So there is a lot of strategic impetus, not just on the economic side of things, to go and to have this whole green revolution for China. It creates opportunities, but also I believe the way forward could be one of cooperation, because economic cooperation and competition can actually benefit everyone. And this is something that I hope in the years ahead, there can be collaboration in terms of technology, in terms of the manufacturing of hardware, etc., to help this whole sustainability drive globally. And I think that's something that we could actually see in the years ahead. But nevertheless, I think the path ahead is still fraught with many uncertainties.
Thanks, and thanks for that, James. Now, I'm going to, since we are already on the topic of being carbon neutral, since ESG has been a highly discussed topic during the past year, and of course for all the right reasons. it's important that we bring up ESG and the focus around it, because there is a lot of misconception in the market that ESG is an asset class or ESG is an investment strategy. But since in Assetona.co, we, work with a lot of investment officers and a lot of investment officers with pension funds are our users. And since pension funds have had a drive to use ESG as a filtering process to filter whatever they invest into, and is considered more of a framework for majority of the pension fund investment officers, we believe that at the end, ESG cannot be, at least from my end, we strongly believe that ESG cannot be considered as just one asset class where you invest only 10%. It doesn't work that way. So that brings us to the topic, since a lot of the other big institutions like pension funds and all are doing a huge push towards becoming 100% ESG compliant. We have also seen that this, of course, comes with a lot of restriction in choosing some investment opportunities, some stocks, some bonds, or other investment opportunities that are there in the market. So is this restriction in investing worth it? Should investors choose to have an ESG positive portfolio or not, especially when it may result in material impact on your returns? So Prashant, why don't we have your opinion on this first?
Sure. No, we don't think there's a trade-off, but it is about ESG integration. This is just, in the long run, another investment factor that you have in your investment framework. Now, of course, a broader ESG integration really leads to a quality bias in your portfolios often. We still have a limited data set and it's early, which means lower volatility. You avoid tail risk in, say, sunset industries. Like, for example, you had in Germany where nuclear power was phased out and the German utilities were hit some years back, just as one example. But on the flip side, from a portfolio construction perspective, how you implement it, there are different indices that have very different sector weightings relative to what mainstream indices have. So there are different ways of doing that, and that's going to have an impact on how you construct portfolios. But we don't think there's a performance trade-off. Ultimately, this will be integrated, and you won't have, in our view, a sustainability strategist. They will be part of the, directly implemented in the investment process of the firm that's implementing, and that's where we think we're really moving. I think where there's confusion sometimes is there are specialist mandates that have a growth bias, like clean energy, but it correlates with growth factors, and then people view them just as growth investments. But overall, we believe them on a broader basis to be higher in quality, which could lead to some factor exposure.
So Prashant, in that case, I want to ask you this question, because right now, of course, the regulations are there, and how you qualify something to be an ESG compliant investment, there are certain criteria in place, but of course, as the years go by, the amount of regulation involved and what will be qualified as an ESG compliant stock or ESG compliant bond, the requirements are going to keep on increasing. And as more regulations keep on increasing in one area, then the choices would also keep on reducing as well. So do you not feel that is going to have a material impact on the long run?
Actually, we think more the opposite, that as it becomes more mainstream, because fund managers are engaging directly with companies on these topics, even in Asia, where there's a big change in awareness, we don't yet have enough data to, for example, we rate our companies on a Clover basis, relying on UN SDGs, but that coverage in terms of our ability to assign one is increasing because companies realize it lowers your cost of capital. For example, if you're raising debt, it lowers your cost of capital if you adopt this strategy. So conversely, we think over time, actually, it's going to be easier to filter companies depending on your investment process, because we're going to have a lot more information. And that's what fund managers want, is information. And then it's up to different firms to assign that weighting relative to other things they're looking at with that company.
Thank you. Thanks, Prashant. Now, Adrian, because we went through this a little bit yesterday during our quick chat, I want to pose a question a little bit differently. So So during the times when UCITS was introduced, of course, it's not the same. But then also when UCITS was introduced, the whole idea was that there is going to be more transparency based on regulations, right? Now, at where we are right now, I have personally seen that there are a lot of Cayman Island funds with the same strategy in UCITS, and in majority cases, what happens is that the UCITS funds ends up underperforming because of a lot of requirements and restrictions that are placed with the UCITS structure in place. Now, again, we are not actually having a conversation about UCITS. The only reason I'm actually bringing this up is because do you not see that going to be the case when ESG and having ESG as and ESG having that as a screening structure on top of whatever you invest into? Do you not see that it may cause challenges in generating optimal returns with another similar vehicle which does not have an ESG screening in place?
I mean, so far not. So let me maybe explain. So when we construct our 100% SI/ESG portfolios, we always start as a starting point on normal indices. So we use MSCI World for our capital market assumption or MSCI US. And we're building the portfolio as efficiently as possible as we do for our normal standard mandates and strategies. And then only on the implementation side, so choosing the right product, we start to apply this ESG filter. And we're running now portfolios since beginning of 2018. And the interesting part, which is not what we expected because we're using basically the same capital market assumption with a few exceptions when we have a specific green bond allocation and we use a specific green bond index. And our experience is so far every year, the ESG SI strategies have slightly outperformed our global strategies because, as probably also I've heard before, some of these companies have less downside risk, they have less volatility. We saw it last year, for example, green bonds, they were barely had any drawdowns in March 2020 because they hold more from institutional investors, they hold them basically until maturity, and therefore you actually can reduce some of the risk and volatility. And I think a lot of people always focus on the E, but particularly there, the S and particularly the G comes into the play where you actually can reduce downside risk. So I would say we will have to see how regulators are now putting up their standards. Probably all of my colleagues have the same sort of task currently, where MIS is the first one that wants to really regulate the asset management business in the ESG space, and how you define that and how you incorporate environmental risk into your analysis and when you build these portfolios. But I also think the dialogue with the regulator is important, and the regulator doesn't want to scrutinize the ESG investment. They just want to set standards, and they want to make sure that what is ESG labeled is also ESG in it. They don't want to necessarily limit the investment opportunities, because I think everybody has a benefit if we get more ESG investments and if we get more opportunities there. So at this stage, if regulations are set in a good intent, I don't think it will sort of limit the investment opportunity and the investment set, that you will see that the restrictions will start to harm performance. It's, as probably have heard before, probably the opposite, as more companies will also start to adopt some of these ESG factors and integrate them. We actually can widen the investment universe, and we actually get even more liquidity into this asset class, or not asset class, I would say, philosophy actually to apply to an investment portfolio.
Thank you, Adrian. And just a question around this: is this something that you have been currently been working with investors on having an ESG focused portfolio, or has it been more around recommendation at this point of time, because it's early stages? Has it been more about recommendations on just investment opportunities?
So we run full SI, 100% SI portfolio since beginning of 2018, okay. Usually multi-asset class, where we We have, of course, on the equity side, of course, we have sort of 4 categories. We use an engagement sleeve. We use a thematic approach. We use a ESG leader approach and an ESG improver approach. And on the fixed income side, we use MDBs as sort of the high grade component. And then we go through that. Now, the interesting part is, and that's probably a good example on how the landscape is changing. When we started in 2018, we had 2 components missing on the fixed income side. We didn't have any high yield exposure into ESG because we couldn't find the right implementation strategy, despite it would have made sense from an asset location perspective. But after 1.5 years, you start to see providers delivering and high yield approach into ESG, and we have then integrated that. And just recently, we were missing so far emerging market debt, for example, as an investment strategy. And we just this week basically started to implement an EM debt ESG solution where we try to invest into MDBs, but we taking EM currency risk to even frontier currencies like the Uganda shilling, for example, where we bridge basically the funding gap and income gap of certain projects in these countries, because they usually finance them out of hard currencies. So if World Bank bonds issuing bonds to finance some of these projects, there's a currency mismatch. So we try to step in, work even on a peer-to-peer level with this project and take on the currency risk for our investors. We are able to diversify that away. And so we actually have now an EM debt component into our portfolio.
Interesting. Thanks a lot for this, Adrian. And I definitely want to speak with you on this one, because the first thing that when we got on the call is that, so what should the panel be about? And then you said, okay, topic 1 should be ESG, 2 should be ESG, 3 should be ESG. So I'm sure you have your views around this topic and about the portfolio being completely ESG compliant, as compared to rather than having just 5% allocation into ESG compliant investment vehicles.
Yeah, 100%. I think it should be clear that ESG, as everyone I think is agreed to, is not an asset class, but is an investment philosophy. And I do really hope if we reconvene in 2, 3, 4 years time, we are not even talking about ESG anymore, because it has already become an industry standard. If all of us are investing according to ESG, and I think what James also just mentioned about all the green initiative, every country, every company more or less wants to become carbon neutral. And I think we from the finance industry can also put some pressure or utmost pressure, I have to say, on the corporate side. And I think Prashant just mentioned this is also a factor of how you refinance yourself if you don't comply to this anymore. And all investors, including all the big asset management houses, would only invest according to the ESG standard, then those companies would easily drop out if they don't meet that criteria. So hence, we at Deutsche Bank here, we will go one step further and not only giving the client that kind of choice, but would imply ESG filter as our utmost investment philosophy. Obviously, there is an opt-out strategy for the client, but based on the conversation we have with our clients so far, the direction I would say is pretty clear that, of course, they rely on us to give them the investment advice. And if we think that investing according to ESG filters would be the kind of standard down the road, then they would leave it basically to us to make the decision also for them. If I look back a couple of years ago when I was still in Singapore, and obviously we were discussing with our clients about that ESG topic multiple times, the answer I always receive at that time was, of course, we want to do something good with our investment. I think that's always for sure, but we don't want to sacrifice in performance. And I think this kind of reversal has already taken place. I think Adrian mentioned this. We observe this the same on our side. Obviously, we currently also run parallel portfolios, and surely the ESG mandates are doing not only slightly better, but from our perspective here and the way how we run it, doing significantly better. I mean, if I just look at also how the markets are viewing certain sectors, right? If you compare renewable sectors versus traditional oil sectors, you can already see the way how multiples are assigned to each and every sector where the market is placing the bet to. And if I look at the best example recently in the car sector, we all know there is one specific company who was at one stage worth more than the entire car industry, although they are just producing 1% of the car production. So I think the markets are starting to value and make the kind of distinction already. And I'm pretty sure if we are not going in that direction the next 1 or 2 years, then you will clearly miss the trend. And that's why I'm saying hopefully in 2-3 years time, when we reconvene again, we are not discussing this as a topic, because it has already become an industry standard.
I agree, and I agree that there is definitely that the topic is going to evolve in the next 3-4 years. So I do want to go back to the other point, and in the 3-4 years that we have this discussion, is it going to be more about regulations? Is it going to be more about limitations based on regulations? Do you feel that may be something that might be a threat for ESG filtering for your whole portfolio, or do you feel that regulations are going to work for the industry?
I think it's more the latter, and as I'm now based in Europe, we are dealing with much tougher regulation when it comes to ESG, and I think this will also apply to the rest of the world. So Adrian mentioned that here for MAS, what we consider and also observe over the past few years, whatever comes out as tougher regulation in Europe has been kind of adopted, especially in Asia as well. So we are very optimistic and constructive that this will also be the case this time, and hence this would rather help us as a money market manager to adopt this kind of philosophy even faster, and hence it is only here good for the entire industry.
Okay, all right. Just as a for a final perspective, Alex, do you have anything to add to the whole topic from your end?
I think we covered it from quite a number of angles, and I think on Twen's last comment, I think while there's a number of different standards, I think for ESG that narrowing those down and I think settling on a more clear set of standards and measurements across all aspects of the ESG spectrum, if anything, will probably clarify the investment universe for clients. So I think that perhaps increase, not necessarily regulation, but I think increased standardization of the different ESG standards would be helpful. I think we're probably moving along those lines, and just the investment universe as well of, say, ESG compliant, whether it's green bonds or specific focus funds on climate solutions or renewables. Those are also increasing quite substantially as well. So I think that we're definitely moving in that direction where the investable universe is increasing, and as we settle on the right set of standards, and I think too you bring some clarity as well. That's much needed for a lot of investors.
Thank you, Alex, and thanks all the panelists. We are finished with our session, but it was good. We went all the way from inflation, and interestingly, we can kind of conclude that all of you believe that it's going to be transitory. I know that a lot of you do not like the word already because it has been overused now in the last 1 month. And then from there, we progress to discussing about the China and the growth in China in the investment portfolio, and China being considered separately as compared to all the other emerging markets, and it should be considered separate as an investment location and investment geography. And then from there we progress into your views of ESG. It was good to have you all on board, and thanks for giving all the feedback for the listeners. Now I'm going to pass the mic over to Nirav so that you can take it forward for the next panel.
Thank you. Thanks so much, Praveen, and gents. Thanks very much once again for joining us for this morning's CIO Morning Bell. Some really pertinent points, some fantastic insights there. It's obviously a substantially wide topic here, so it probably warrants its own a couple of hours, I guess, forum. And we also want to thank you all for participating in the Q1 CIO Insights, as I mentioned earlier. That briefing is ready. It has been disseminated worldwide. And we will also be providing a recording of this video as well. So all of you in the audience will have access to that. So once again, gents, thanks very much. Have a good day, and I'm sure we'll see you soon. Thanks very much. We're now going to move swiftly on to our next panel, where I will introduce 4 of our speakers. So this is a slightly smaller panel, but an incredibly important topic nevertheless. So we're really focusing here on digital innovation and looking at the sort of digital acceleration in the private banking and the private wealth landscape here. So welcome to Sasha Michelle Walker from Julius Baer. Sasha is actually the Managing Director and Head of Strategy and Business Operations for Asia Pacific. He's going to be joined by Shilpi Chowdhury from Lighthouse Canton. Shilpi is the CEO at Lighthouse Canton. Also, very welcome to Sumit Apambri, the Global Head, Advisory and Client Engagement, Wealth Management at Standard Chartered. And he's going to be joined by Laksh Gangwani, who is a Strategic Advisor to Global Private Banker. So let's move over to the live session now, if we can bring in the speakers. Here we go, and good morning to you, gents. Thanks so much for joining us. Laksh, I'm going to pass the floor over to you, so feel free to take it away when you're ready.
Thank you, Nirav, and thank you, gentlemen, for joining me for this amazing panel. And today, as the topic suggests, we will be discussing about unlocking value proposition for the next generation. And so there has been a lot of burning questions around this. So let me get started with the first one. And the first question that I hear around wherever I go is, as wealth management decisions are going from the first generation to the next, what is the difference that you see in the approaches taken by the 2 generations? Shilpi, could I start with you?
Yeah, Laksh, good morning to everyone. Yeah, I think it's a very interesting question, Laksh. I think the first generation, is a hard-earned money. The guys are still very traditional in nature. And I think as we are seeing the shift happening to, I would say, millennials for all practical purposes, I think they are very hands-on. They definitely like to, look at private markets very actively. They have seen, massive generation of wealth by, some of the companies which have come into listing in the last 10 years. And these were largely startups, 10 years back. So I think they are very, very active. They're very knowledgeable. They want to have, far more decision making. And so all the traditional, ways of which I think all of us were used to managing with our clients, I think some of that shift is definitely taking. They are also very technology savvy. They are able to, and they demand more, technology enablement so that they can take better decisions. So I think these are some of the nuances that definitely come to the fore.
That is a very nice perspective. Sumit, what is your opinion? How is the next generation different from the current one?
Yeah, hi everyone. Good morning, and thanks for this opportunity to share my views. Actually, I quite agree with Shilpi, right? I think there's a massive amount of wealth transfer that's going to happen over this decade, and largely handing over to millennials. The way I look at it, I see it. I similar points, but I would see it slightly differently. One is around how these people, how the millennials consume information. These are all digital natives. A lot of them were born after the iPhone, and that's the first thing that they are that they know of as a device. The channels they use, the way they consume social media, completely different from how their parents used to. The other difference I see is in terms of what they value. For them, sustainability and the impact that they leave behind is quite important. They've seen their parents work very hard to generate wealth, and now how they manage that from here on, the responsibility that they see is quite huge. The third bit is around, and this is interesting, right? Who they trust. In the past, their parents used to simply trust their relationship managers and people at the bank. But I think the new generation would not depend on any one source for information, and they are consuming that information from many different sources, and that definition of trust is slightly different. And I also see a huge difference in the way they approach wealth management. I suppose because they've come into money, they're a bit more structured in terms of how they see their money. And to Shilpi's point earlier, I think they're a lot more confident. They've dabbled with equities, they've dabbled with private markets, they've seen some massive amount of success there, and therefore they're a lot more confident in how they manage their wealth. I think all of this makes for a case that we do need a massive multi-pronged approach to how we manage, to help these new set of clients manage their wealth, whether it comes across channels, whether that's around what we do in personalization to become more relevant, whether it's in terms of how they execute, and consume advice. So a whole lot of different changes that are coming our way.
Thank you for sharing that. You actually make some really good points, and I will come back to you and ask more about the multi-pronged approach and the channels and digital. Now, Sasha, a slightly different question for you. Could you also think about or share not only what the differences are in your opinion, but what are the similarities as well? So,
yes, thank you for having and hosting me here today. I think what we have to keep in mind whenever someone is a new generation or the next generation will become also the first generation. So I think also the behavior going to adopt over the time and is getting closer to the father than he is as a son. So I think this is something that we also have to keep in mind, that not everything is going to change from day one to tomorrow. But I think, as mentioned before, there are aspects where are really differences. What is seen in general, what is the common pattern? All types of clients, young or old, they are very transaction oriented. So it was not a shift we expected from a delegation of investment decision from a bank, from a client to a bank in that scale we expected. I think it's still that also the younger and the older generation will be a part of the decision making and a part of the transaction. But we also realized that didn't change. Even we have new platforms. It was always also in the past, clients were always very fee sensitive. Depending a bit from region, when we are looking at an NRI client segment, fees are very sensitive. When you go into other sub-region, maybe less. But I think for all of the clients, it's a similar pattern here. And I think what is also important, I want to highlight as a private bank, even having opportunities out there, which is maybe more technical advanced than a private bank is. I think brand is very important. We see that it's like driving a new car, a nice car. I mean, if you tell in your relation, in your environment that you're banking with one of the top 5 private banks, I think this is very important for young people, but also for old people. And last not least, I mean, we also realize that clients here are not depending from age, are very, very decisive. I mean, once they have something in mind, they want to execute fast and not wait for another 2 days to someone to coming back. So I think this is maybe the common aspect.
Thank you, Sasha, for sharing that. Now, Sumit, coming back to you, and I think what you mentioned was there is a need of a multi-pronged approach. that dives us right back into our next question is how important is the use of technology for the customer experience part and digitally enabling RMs for retaining the next generation of these private clients? If we could start with you.
Yep, thanks, Laksh. So I see this as a sink or swim situation, right? There is an absolute need for all private banks to keep pace with all the emerging digital opportunities out there. Our clients, new or old, and new more so than old, are used to social media and are used to big tech. And these have become the new benchmarks for client journeys, for engagement, for personalization. And clients have started to expect that kind of experience from us as well. And I think banks need to really pick up the game in this space. And as I see it, I think tech is vital to re-engineer the entire client journey, whether it's how we onboard clients, how we engage them, how we help them discover their needs and preferences, how we advise them, how we help them execute, and then post-sales, how we help them review their portfolios. The other big aspect I see is around reducing the RM non-value added time. I think this is one of those things we've been talking about for a few years, but I think with the tools being available now, I think there's even greater need to fast track our efforts in this space. So that's where you get a lot of banks coming up with new digital advisory tools that can help us both institutionalize advice and help our RMs build client portfolios in the most efficient way. And then on the other side around execution, it's a good balance between RM assisted channels and building client self-serve capabilities. If I just take an example, right? In the past, I think retail banks have been used to building self-serve capabilities at scale because that was the only way to achieve scale. But I think a lot of the private bank clients are also demanding the same set of self-serve capabilities because if you want to trade at odd hours of the day and with markets being open most of the time, and now even on weekends for some of the crypto assets, you increasingly want to be able to do stuff on your own. And that's, I think, a core trend that all of us need to address and be able to deal with.
Thank you, Sumit. That was an amazing answer. Now, coming back to Shilpi. Now, Shilpi, same, use of technology and how do you bring that into customer experience and, digitally enable RMs. And I know you have been doing some really exciting work back at Lighthouse Canton, so would love to hear more about it as well as you answer this question.
Yeah, I think, Laksh, some of the things are pretty obvious to everyone, but I think one of the more fundamental things to look about is that technology is a great leveler. Earlier you needed to be a very large organization to be able to do dollar spends to bring in the technology and then compete with the rest of the world. But today, I think even smaller players can actually outdo some of the bigger players because of the nimbleness that they can have and the technology suite that they can present to the world. If you really look back at any industry, I think one of the things that those industries scaled up, they scaled up because those platforms were available. And banking, to a larger extent, remain, I would say, very less prone to innovation. I would say the innovation has been almost moving at a very slow pace. I won't say not there, but I think relative to the other areas. But now, I think, with the cloud computing, with platform as services, you can even have payment as services. You can even have deposits as services. And I think licenses as services is not too far away. So I think there is going to be a huge competition in this space. And I think the banks will have to gear up. Institutions like ourselves will have to gear up to make sure that we are giving a great user experience, because one part is enabling them to be able to do a lot of work on the technology. But the other is, I think it's also something that you've got to keep in mind, the end user experience. And I've seen that is something there has to be a lot of attention that we need to pay. And I'll give you an example. One of the initiatives we've driven is that, the communication channels which are traditionally being used in most of the financial institutions have been either emails, voice logs for all your orders, or, traditionally fax, which was pretty much a bygone era now. But we thought that more and more people, and that's an insight you can see for yourself. How much time do you spend on reverting on a WhatsApp or a WeChat versus on an email? And we felt that I think that opportunity was right up there. So we integrated our systems with WhatsApp and WeChat, and our clients can place orders on WhatsApp, WeChat. We've also created bots whereby they don't have to worry about giving lengthy instructions. They can all literally give a yes and a no or a 1 or a 2 to say that the orders should be processed. And I think we've made it seamless with the private banks to then place those orders. It's a great user experience. B, I think it helps them to be able to place orders as and where they want to place it and not be restricted by the access of emails or phone. And lastly, I think it's a secure way of doing it, and also almost ensuring that you have next to no mistakes at all, because I think from a regulatory perspective, you want to make sure that you get these things right. So I think this is one use case, and you'll see multiple use cases down the line. And I think we are looking at analytics as one of the use cases where you are enabling people to make better decisions driven by data. And I think Asia is still, data access is a big issue. I think the banks are still, not all banks, I would say, but a lot of banks still need to work on the API accesses. And I think that uniformity is still not coming in Asia. And I think it's inevitable. It has to happen because that will increase and drive more user experience, but also, basically people to adopt technology.
Right. Thank you so much, Shilpi, for that. And I must say that I have had a ringside seat to look at the digital transformation and innovation at Lighthouse Canton. So it is very impressive with what you have achieved. And we are very lucky today that we have Sasha on the panel as well. And Julius Baer has been leading some of their own really nice digital initiatives and digital first initiative. So Sasha, the same question back to you, the role of digital technology and enabling RMs and giving customers an experience. And if you could share some thoughts about the new DIAS platform that you guys have just come out with.
Okay, DIAS sounds a bit funny because in English you call it DIAS, in German they call it DIAS. So, but it's meant digital advisory suites. Digital advisory suites was recently developed in Europe. Pressure from regulator to comply with MiFID. So at day one is a purely regulatory tool. Over the time, we had the opportunity to learn from the past and making it like an efficiency gain, plus also like a client specific tool. So what is DIAS about? DIAS integrates various systems. So you have a suitability component, which is integrated, I think, which is a precondition to even initiate a trade in Hong Kong. You have a constantly monitoring on the portfolio. And at the end of the day, based also on data that we generate, you will have a client element. So one is the efficiency gain, because before you were operating 5 systems and you now bring it down. So that helps a lot of to freeze up capacity for relationship manager to focus on advice and on acquisition. From a client servicing perspective, I think the add value is that the relationship manager is only receiving ideas which are relevant for the client. A few years ago, we were living in the so-called 1 to N PDF world, where specialists sending out investment ideas to the whole group of RMs. The RMs, if they have time, they filter it and then may specifically send it to the client. And then the rate that the suction email received the client was below 1%. Now with a customized device, the RM is already very sure what I'm receiving is relevant and can then provide it to the client. It's not a solution yet where the content is going directly to the client. We want to avoid this for the time being until we have a stability in the system, but also that the RMs understand, and I think this is very important. We also talk about digital. What is the algorithm? What is the methodology behind it before it goes to the client directly? And I think this is a precondition as they understand, they feel comfortable to go to the next journey to send it directly to the client.
Right. Thank you so much for sharing that, Sasha. Sumit, I just want to come back to you because you made a really interesting point about digital self-serve. And given Standard Chartered has experience in managing across the wealth management landscape in private, priority, and retail, I am assuming Standard Chartered would have a head start in the self-serve capabilities. Could you share something more about that with us?
Sorry, self-serve?
Digital self-serve.
Sorry?
Digital self-serve. So I want to ask Sumit the question about how their experience about digital self-serve and how they think it would change the engagement of private banking clients.
Yeah, absolutely. So I think, Laksh, to your point, one of the core efforts at our side, as we go forward, is obviously to offer a large number of the self-serve capabilities across asset classes that we have available to our private bank clients as well. That cuts across equities, across multiple exchanges globally, FX capabilities with Order Watch, funds capabilities, and also the ability to start to send product ideas directly to clients in a more personalized way. Already, we send product ideas to each one of our private banking clients every single day. I think we're one of the few banks who do that with quite a bit of regularity. And then, bypassing the RMs as a channel to do that. That really helps us ensure that all of our clients hear from us on a regular basis, and we can continue to build in this space. But I think as we go forward, I think I would agree with some of the comments made by Sasha as well. There's a lot more elements around personalization, around relevance that we can focus on, and start to think about a lot more about what are the right channels to engage clients for different types of communication. If it's about house views, how our clients like to receive it in the past was purely through EDMs. Now I think there are new channels like podcast channels that we already have in the bank, from where our clients can listen to house views and not just read them. These become short 3-5 minute bursts that are much easier for clients to consume versus reading their emails again. If it's about sending a very time-sensitive product idea, that's where tools where we can send ideas to clients through WhatsApp or WeChat or whatever channels they can engage on very quickly become super important. And wherever there is personalization, then you try and keep it into channels that they would expect that from, which is more the core banking app that they already use. So we're thinking a lot about, a lot of stuff around what kind of information, what channel, how do we personalize it to increase the amount of relevance and the speed at which clients can consume, absorb, and act on that information in a very timely manner.
Absolutely, Sumit. And you make a really good point there and about the communication and personalization. I will drill a little deep into this. And I think WhatsApp, WeChat has come up many times in this discussion. So Shilpi, coming back to you, now we are hearing a lot about these different channels. We have heard about doing podcast, WhatsApp, WeChat, etc. Now, do you, this is a two-ended question. The first part of the question is, how important do you think is choosing the right channel for the right, target audience? And two, where does this end? Does this end in you going into AR, VR, and, there is a virtual reality RM in front of the customer whenever they want? Where does this end? What is the, futuristic view of it?
Yeah, Laksh, I think the first part is, I think Sumit has rightly said, I think it's about personalization. You can't have, use an approach which is basically assuming everything will work for everyone. I think you've got to customize, but keeping convenience and security, I think these are two hallmarks. I think security for the banking world is an extremely important thing. All things equal, I think you'll give security the first feature. And then comes down to the point of, what is easy and convenient to access. So I think the world will find a way, if WhatsApp and WeChat have to, or any chat communication channel, rather than putting any name, if that convenient, I think you would see more functionality and more features coming around it so that people are able to do multiple things on that channel. It's a communication tool. And if we move one step forward, right, and your question about where is the future, I think the future is all going to be about how technology evolves. I think when 5G comes in, your latencies will come down, and I think you will see more video calls between clients. I think COVID only taught us this. It's only accelerated this whole trend. This discussion would have happened in person, but we are doing it virtually. Our clients were pretty, used to meeting or having, meet over a lunch or a dinner. And they're very open now to have calls, and they've realized the efficiency that comes with some of these tools. So I think, one has to keep pretty open to the fact that new technologies will emerge. And as long as you're open to the idea that, you got to, keep looking at better ways of serving your customer. And I think I keep bringing this whole point of user experience, because in my mind, I think that's a very significant part, because we can create anything, can be very savvy technology wise, but if the experience is not good, then I think it's not sustainable. So, and you can see that in consumer products, you can see in Apple, I think the amount of time and energy they focus on consumer experience and user experience. I think that's something that you would see more and more in, and personalization is nothing more but trying to give you a user experience which matches your preferences.
Absolutely. And Shilpi, thank you for sharing that. I have a follow-on question, but I'll come back after I get Sasha's view, because Sasha, you guys have had a lot of experience using digital platforms for engaging customers, and you have rolled out some of this. So would love to hear from your perspective on what works, what is your experience, what could be the learnings that you would share with our attendees today.
Okay, just apologize that I interrupted Sumit before. I think there was a little connectivity issue, so it shows again how personalized context sometimes could be even better. But now going back to that point, I think a general statement I want to make is when you're talking about personalization, it's important. Nevertheless, there is always a client preference. So we cannot generalize that personal advice is something that every client likes. So we have clients, they love to attend physical conferences and they will never show up for a webcast. We have other clients, they avoid this kind of events. They not even like to go for a client dinner. We had once a young startup, now listed company in China. There was a dinner with the CEO and he didn't want to go because he said, I'm the client, so why is this an honor for me to meet the CEO? So I think there is always differences in the preferences of client. But on the other hand, we also have to look into scalability. And what we tried in Julius Baer is coming away from this mass emailing, what I mentioned before, more to a customized way. It will prove what is the impact with the introduction of DIAS. What we also try to do is kind of a direct-to-client emailer. So there is no R in between. And if you have some ideas, we believe in the space, ESG is a big topic, we talked before about this, then we selectively reach out directly to the client and see what is the perception and what is actually also the action of the clients. And what was also very interesting, when we started it, 90% of the clients open the email and maybe 10% act on the idea. As more emails you start to send, even it's labeled by his name, we see a decline. So we have to look at other ways. Other ways is now, we also introduced the WhatsApp functionality. I think this gives you really the opportunity to act very fast on something the client is looking for, or also providing an idea as a follow-up very fast to the client. Then there are other channels, and maybe this one I quickly want to share with you. We were very surprised. We came up maybe as a late mover with the podcast series in Asia starting at beginning of this year. We didn't have any external promotion activities, but only within the network. And we were able to reach out over the last 6 months to over 8,000 listeners. And I think it seems there is a need, and there is a consumption pattern that has changed. And I think this is also something that would help to support the customized, personalized advice. And then there are areas where we cannot talk about technology. This is when you are entering the space of wealth planning. I think there is always a personal conversation in a wider group more important. I think it's very challenging to convert this into even you have the data and you consume the data will maybe help you to prepare for the meeting. But I think to actually even automatization is in this space maybe not really possible.
Thank you so much, Sasha, for sharing that. And you make some really great points. And being one of the listeners of your new podcast series, I actually agree it is a very insightful and it shares some really great perspective from the bank. So now there was this really nice point made about new technology and clients preferring interactions which are remote and digital. One thing that pops up in my mind is that if the clients are becoming so comfortable with technology and the entry barrier to meeting them is so low, would this mean that private banks would now face even more competition as they move forward? Because now the client doesn't have to be in Singapore, in Standard Chartered or Julius Baer or Lighthouse Canton's office. They could be sitting right back at their place and they could be speaking to 5 or 6 RMs together to see who could do the best possible job for them. So Shilpi, what is your view on that? That would technology make the playing field more level, and will the customers have more choice and would play, banks or private banking offerings against each other?
I think they will have more choice. There is just no question about it. And I think, it's not only about, ease of access to information. It's also about, I think, new platforms which will come up. And I think there will be more competition. We keep talking about DeFi and we keep talking about new channels of delivering services. And, the big technology companies, if you look at Apple, if you look at, Facebook, they're already in big way in the payments space already. And that's including into the banking space in some form and fashion. Now, it's a regulatory, challenge because I think technology by very nature is disruptive and regulations by very nature are very, they have to be within the boundaries. So I think those are certain challenges some of these companies are facing, but I think the banks just need to kind of get their act together. We all need to get our act together to make sure that we lead some of the innovations in this space. The good part is, I think, with serious clients and serious money, I think Sasha mentioned a point about, having a brand. And I think that brand definitely brings a bit of trust. And I think the only submission I would have is that what took you to build a brand in 20 years, these days, the brand building can almost literally happen in 5 years or 3 years. And big brands are being dislodged very, very quickly. So if people don't get their act together, then obviously some of these things will definitely be very disruptive. So I see in those lights, and I think self-enabled platforms or platforms which probably help you make better decisions, I think are going to be driven by data. And I think if you give people the access to data, which can be then, today, I think from a financial world, I think there are enough complexities out there. And that's why you need a wealth manager who comes in, and you need the host of solutions coming from the banks, because it's not an easy decision to make, right? How do you make sure that you reduce your risk, at the same time achieve your goal? How do you make sure you achieve your cash flow goals? So on and so forth. And there are new products which are coming all the time. And how do you balance and rebalance your portfolios? But some of these tools are going to become so intuitive, and I think technology definitely will play a role. So I wouldn't say banks, but I think for sure a lot of relationship managers and channels through which the services was being delivered, I think they will go a big change for sure. And I think that's where I think technology will play a big role.
Thank you, Shilpi. Sumit, if I can come to you, Shilpi made some great points about technology being an enabler, and you made a point about self-serve, etc. So if you are an RM today, what can you do to make sure you can manage all this competition because of digital enablement and coming in from self-serve? There are other RMs who are on digital channels, and clients have a flurry of choices. So as an RM, what do you do to manage this incoming competition and retain your next gen customers?
Yeah, thanks, Laksh. I think in my mind, I think I would put this down to personalization, right? And as some people call it, hyper personalization, right? If you think about it, right, the concept of personalization is not new and has existed for generations. In fact, if you think about it, in the past, clients chose RMs or banks who they thought understood their needs better than the others, right? And were able to address them. So that concept is not new. And if you talk to any good salesperson, right, they will know their conversion rates. They would know that, it's all about relationships and how well they know an individual that will really define what they do with these people and how they then turn that into a wow factor for the client on the other side. Now, if you think about it, right, each client has unique investment preferences. They've got a unique background. They've got different ethical beliefs. They've got different life goals, and they've got different risk profiles, right? And I think with personalization, you can actually start to tailor your portfolios to these specifics. Now, the challenge has been that in the past, we've let the RMs deal with all of this on their own. And it was we were relying on the RM's intelligence and their understanding of each of their clients to deliver that. I think now with technology, I think we have the ability to institutionalize a lot of these elements and start to deliver this at scale so that we can deliver this both via the RMs as well as directly to clients. And I see this in a few areas, right? Whether it's about individual portfolio construction, where we can take each of the clients' risk profile, beliefs, or clearly no-go areas that we can incorporate. It's about next best actions around what the client should be doing next to meet their life goals, to what they should be doing with the next dollar of incremental investment that they make. It boils down to what their ESG and social preferences are, what amount of, and what their impact beliefs are, right? And where they want to really create that impact. We can create that differentiation in how we deliver personalized reporting. Some clients like to look at their reporting in terms of where they are in terms of their life goals. Some clients to see their reporting in risk metrics. Some clients like to see their, and we are beginning to see this a lot now recently around the ESG metrics, right? All different elements, but the same reporting view can now be presented in so many different ways. And last, I think we've spoken about this quite a bit already, which is around personalized content delivery, whether it's market research, whether it's product ideas, whether it's next best actions, whatever. So I think there's a lot of different things we can deliver to our clients if we start to use technology, and this will all help us bring that personalization and that wow factor as far as client engagement is concerned, and they would start to see this in all their interactions with us.
Absolutely. And Sumit, that is a very nice summary. That brings me to my favorite topic, hyper personalization and the wealth management industry. Like any meeting I am in with anybody in wealth management, hyper personalization is like number one or number two topic to be discussed. Now, Sasha, when we were speaking, you made a really very interesting comment about going from mass communication to hyper personalization. So, and I have noticed that a lot of organizations, not only financial institutions, but a lot of organizations, they believe in mass communication. They would just change the name of the person or some aspect here or there, and then send out that communication. And you shared some data around that as well. So would one love to get your view on hyper personalization as you and Julius Barr, and of course a little bit more about that journey from going from mass communication to hyper personalization. So the floor is yours.
Thanks, Lux. Look, the hyper personalization comes into the picture in a time where we have an overflow of information. We consume information almost maybe 18 hours a day when you're not sleeping, and that could be on your mobile phone, you're reading the news. And I think this is just a max you cannot absorb. I think there is only a certain capacity your brain can proceed. I mean, I see this every day, even when I'm opening the letterbox, and I see, okay, it's just a statement from DBS, which I say anyway have online. So one of my bank, I just throw it away. I'm not even opening it up because I know what's in there. The same is with email. I mean, I'm receiving about 300 emails. So can you guess when I get an email with an investment recommendation, which is a mass mail, not really personalize it, I will not give any attention to this. And I think it was very clearly highlighted how you achieve personalization is based on data. But there are limitations. We have to face that data quality may not be there. For certain clients, they're new clients, so we don't actually have the history and the trading behavior. But there are always also blind spots where maybe data are not enough to do the interpretation. But I think this is the backbone for personalization, but it cannot be exclusively based on data. So we have to bring in some other elements in, is like the communication with the clients. For example, when we're going to the topic like ESG. ESG is a very broad topic. So when you maybe in Asia, you may have a preference on environment because you see the city is getting polluted. When you go to Europe, you have totally other preferences. I mean, there a lot of environmental protection have to be already done. People went through the thought process, and now topics like diversity, LGBT rights are a topic there, but it's in some jurisdictions not possible. So I think there we also have to be always to understand what the client really wants in a more detailed way, what is then just where your rubber stand with ESG. And I think there is another thing, what is very difficult, but I think we have to incorporate that is how the client would, I mean, we can maybe read the past behavior, but how he will react in different cycles, external factors like a market crash. Because when we are now in an upside market for the last 10 years, never had a crash, we may not even have the data to project the behavior on that one. So I think the models have to be much more complex than using data, but not only client data, but also like other data which are outside there, plus combined with a personalized talk.
Thank you so much for sharing that. That gives a very futuristic vision of where we could be. Now, Shilpi, coming back to you. So you mentioned hyper-personalization is very important. At the same time, I also know that you are using bots to offer a very automated and self-serve experience to your customer. For a financial institution like yours, what do you think would be the leading growth factor? Would it be hyper-personalization, where your RMs know even more and they're taking even much better ideas to your clients, just like Sasha mentioned? Or would it be these digital self-serve automation bots where they can come in on WhatsApp or a social messaging platform and give you so where do you think you would see that growth coming in?
Yeah, I think, Laksh, I think the first part is, I think there are enough problems to be solved out there. And I think there are enough opportunities that lend you for growth. I think everybody here on the panel has mentioned about, how you can get data enablement, right? And I think there are various forms to do that. I think the first is to help your clients make decisions in a simplified manner. I think that's some substance of everything. Whether we use RMs, we use technology, I think that the idea is that they should have a clear idea about what their goals are, and any decision that they are making is helping them get closer to their goals, or it's kind of further away from that. So I think there are enough low-hanging fruits. I think for us, I think what we are trying to drive here is we're trying to make sure that we are able to consolidate data across clients' portfolios across various banks. We are, to some extent, bank agnostic. We work with all the banks that are partners. But for us, I think it's client centricity, which is most important. And the second element then I think comes down to is, once we get that data, how do we make sure that it's a meaningful information that you derive out of that data? And the third element would be then, how do you make sure that you provide the channel and whether it's RM assisted or self-driven, that you are able to execute and get more reliable and more integrity on that data. So if we can do that, I think everything else will fall in place. And I think then it's all about bells and whistles. It's about listening closely to your clients. If somebody is very ESG driven, I think our portfolios, when they open up, I think to that level, the hyper personalization should happen. That we should know that this is a client who has preferences. And that's a role of a CRMs that play, right? You integrate your CRMs with your portfolio management systems and then your order management and execution management systems to make sure that, you are taking note of those nuances. And I think it's a continuous journey. I think at some stage you will have machine learning and other stuff coming into picture, but I think that's nothing but using data to make better decisions. And I think that's where we are focusing, and we'll continue to focus in that direction.
Thank you, Shilpi. Sumit, coming back to you, and I've been making notes about all the things you guys have said. So I know that when you were speaking, you talked about, next best action and self-serve coming to private banking clients. So it seems like from a technology perspective, technology that was for retail customer now starts going towards the private banking customer. And from a product perspective, and this is based on some observations, now even retail or mass affluent customers have access to products which they did not have before. So would love to get your views about this observation now.
Yeah, thanks, Laksh. I think a couple of points, right? One is I don't see this as retail technology going to private bank. I think it's more about identifying and starting from the needs of our clients and their preferences for how they wish to be served, and then finding the ways to serve them, right? And the reason why we are building all of those self-serve channels is simply because we've been hearing from our clients that they would like to have access to those channels to do things themselves. A lot of private banks have had equity dealing desks to help their clients trade equities. But to place a simple trade for an equity, you don't need to be calling someone, right? When in today's day and age, you can simply place that order online and get instant gratification, right? So I think it all starts from the needs of the clients and what they're looking for. I think the second element here is around the fact that there are so many different ideas. There is so much information that's out there. How do we really make sure that we process that and deliver the most relevant bit of information and inputs to our clients? Because that's the role that we play in the new information age, right? Which is around curating a lot of the information and delivering it to them in a timely manner that they can act on. So if you start from the needs of the client, then everything that you do from a technology perspective is simply an action that leads to the end goal of serving clients. So that's the perspective that we work with, and that's what we are trying to constantly embed within our interactions with all our clients.
Thank you, Sumit, for that. And that brings me to a very interesting discussion point, which is big tech. So any discussion anywhere today, you cannot just miss big tech and their entry into financial services. Shilpi just mentioned they're into payments and some other services. Now, I have a few questions around big tech. So I'll start going around and asking, Sasha, why don't we start with you? Now, big tech has managed to capture the attention and of all these millennial or next generation customers. So what is one thing that private banks could learn from big tech?
Okay, I mean, maybe this is a different way. Maybe I see it, and may others in this bank. I think big technology companies, they're already advanced. I mean, I think when it comes to technology, because they had this the vision 10 years ago, and I mean, we lost people who were developer at Julius Baer, and they went to Google because it's much more interesting. They can work on a sandbox approach, and there's no pressure, and they can spend years to develop something. So I think we are lagging behind them, and we will never catch up with the fintech or with the big tech companies at that point of time. So I think we can chase, but we will never reach. So what is an option to cope with this? I think it's cooperation. I think we should see us as a complementary solution. So what is big tech are missing? They may have the technology, but they don't have the experience to deal with ultra high net clients. They don't have any product knowledge. And I think product is the core because you're executing on a core. Except you're a very execution-driven client who is actually acting without advice of the bank because he is very decisive and wants to what to do. But I think that the product knowledge is something that as a corporation we can bring in, and we did this also when we had a cooperation with our Thailand joint venture, where it's not related to tech, but it was related to relationship management, where they're onshore, they're having the client, and we bring our product knowledge. So I think a similar could apply for that approach. And I think also that the element of a personal relationship is very important. So I think PP will bring a set of competences, and the tech will bring. And I think in the future we have to learn how we can cooperate with each other, because I think as a combination of both, it will bring the most added value for both, but also for the client.
Thank you, Sasha. So you look at cooperation as one of the next steps between big tech and let's say big private banks. Sumit, that was a very interesting view. And I know Standard Chartered has, though it is a bank, but it has been investing very significantly in technology. So what do you feel would be the difference between Standard Chartered versus a big tech which now starts offering wealth management, at least to the retail side of customers? So what do you feel would be the biggest USP for customers to come to Standard Chartered?
Maybe I answer this in two separate parts, right? One is our USP. I think we've been in this business for many years, and we've been doing wealth management for a long time, and we understand the nuances of this business. But I think more importantly, I think what we have to think about is what we can learn from big techs, right? And where we think we need to learn from them. Two areas in my mind, right? One, I think, is client obsession. We have seen the way a lot of the big techs have been obsessed about delivering client outcomes and not getting bogged down by our own internal challenges. And I think that's one big leap that we all need to make and drive the entire organization to become a lot more client obsessed. I think the second part is how we can be a lot more nimble and agile in building things. In a lot of us banks, I think we usually take a very waterfall approach to building new platforms, and we take a long time to develop. I think we need to start taking a more agile approach to how we simplify things for our clients and how we deliver solutions to our clients. And I just quote two examples. I think Shilpi mentioned Apple earlier, right? So two examples from there, right? One, when you get a new iPhone, no one actually gives you a manual to say, how do you use an iPhone, right? They don't even tell you which button to press. Yeah. And they've not even done it with the first iPhone that was launched in 2007. That's never been the case. You got it and you knew what to do with it. I think that's what we need to learn from them, right? And if you think about the operating system that was there at that point of time versus what we have today, they've made massive differences. But they've done this over many iterations, right? And it's not that they waited for iteration 14 to eventually launch the platform. They launched it at iteration 1, and they've continuously focused on improving it every single year. I think those are elements that we really need to learn from big techs so that we can significantly enhance our services that we deliver to our clients as well.
Thank you, Sumit. That is a very nice perspective. Shilpi, coming back to you, and we are coming to the end of the panel. So you are absolutely a very forward-looking financial institution. You've mentioned so many innovative things. What could you learn further? That is the first part of my question from big tech and some of the technology-driven companies? That is the first part of my question. As we end the panel, I also want to ask you, and Sumit and Sasha, I'll come back to you as well, is what is one thing you could change in the wealth management industry today? So Shilpi, let's start with you. Sasha and Sumit, I'm coming back to you as well for this last part of the question.
So Laksh, I think, from the big tech, I think one of the things that we would want to really imbibe is the culture, right? I think the culture that the big tech has built, it's about being able to go out and fail quickly. Whereas I think in the financial institution world, I think failure, it's almost a taboo for us. And I think somewhere, I think we need to define boundaries to make sure that there is that a safe space where we can go and experiment and not be, really put up for explaining the failure, big time. So I think that is very, very important, because there is no innovation going to happen if you don't do that. And of course, I think when it comes down to partnering with them, I mentioned this earlier, and I think I'm saying this again. If you go back and look at the development go back to 2000 when .com happened, and I think there was a huge bust. If you were to set up a technology company in even 2000 and 2005 or 6 also, I think you would have to spend, let's say, for even a medium-sized company, $1 million on buying racks and all these kind of hardware devices before you could just, or maybe if not $1 million, couple of $100,000. Today, you can just start up something, with a couple of $100 and get an instance on a AWS or some of these things. And I think that whole development of cloud platform enabled huge amount of new businesses to come out and, basically become very successful. In the financial world, that's not happened, but it's bound to happen. As I said, I think you would see payments as a service. I mean, we can literally start a bank if we get a license, but I don't need to set up my whole payment infrastructure. If I get payment as a service, I think then, it's a technology-enabled service. I'm in the business of payments. And similarly, if I say compliance as a service, right? So all my KYCs, all things are taken care of. And I think I know that it's a reliable, high-quality service. And if I were to build it myself, probably will not be able to scale up that much. And I think that revolution is bound to happen. I think it started in the US. You would see in next couple of years happening. And I think Asia will sooner or later catch up at that as well. So for us, I think it's the culture that we learn. And one thing that we would want to do in the wealth management space, and I think we're continuously making that effort, is to make sure trying to bring about as much transparency and alignment of interest that is possible. Because I think in our industry, still it's pretty much transaction driven. I do see a lot of businesses where clients have no idea about how much they pay and what they pay for. And I think if we can just bring about that transparency and accountability, and I think that's, to us, our USP and something we focus a lot on.
Thank you, Shilpi. So just to summarize, bringing in a safe space to innovate and fail, bringing in more transparency. Thank you so much for joining us today and for sharing your views. Sasha, coming back to you, what is one thing that you would like to change in the wealth management industry today?
Okay, I mean, what I personally think, that's maybe also an experience that we had over the last 10 years since I'm in Singapore. We grow our business from a 20 billion business up to a 110 billion business in private banking over the last 10 years. And actually, we could achieve this only because we had a very, very strong focus on the relationship manager. So it was all about acquisition of relationship manager. It was about integration. We integrated Merrill Lynch, US into Julius Baer. And that was the place where the money was spent. And I think now we achieved the critical mass. And now the shift, and it already started, we shifted the focus from an RM-centric organization to focus on other topics. And I think technology is a lot. So I think this is what we can learn that as a private banking. And maybe just to add on the agile part, I think also since 1.5 years, we are fully agile. But what we also should learn out of this, when you go into the planning or into the priorities, I think it's always the same people, and it's Julius Baer's employees. But people may have totally different views. For example, when you talk to one of our senior managers, for him is payment on e-banking the most important one, which I personally think it's not a priority, but that's just a preference. So I think we should also, when we are going into the agile, we should also have getting a client perspective. And that's not only by the ORM, because ORM is a filter. Maybe we should even go explore further that we're bringing clients in, or we're bringing people with external perspective into the whole things, and not just isolated as an institute.
Thank you, Sasha. So bringing in the client's perspective into agile planning, and great point on making the transition from RM centric to technology driven. Sumit, coming back to you, what is one thing that you would like to change in the wealth management industry?
I think the one change that I would push for is to significantly step up the pace of innovation. I think we all talk about innovation a lot, but I think our industry still lags behind many other industries in the pace of innovation that we see. And then, how we do that, I would go back to some of the points that Sasha and Shilpi have made as well, around failing fast, around keeping the clients at the heart of what we do, and also making sure that we continue to try different things, right? And some of those would work, some of those would fail, but let's keep innovating, let's keep trying. There is no other option. That's an absolute imperative for all of us.
Thank you, Sumit. And just to quote you from before, it is sink or swim time for the private banking industry. Thank you, Shilpi, Sasha, and Sumit for joining me this afternoon for a really good discussion on unlocking the value for next generation. I thank the audience for dialing in as well. I am Laksh Gangwani, and I am signing off. Over to you, Nirav.
Thank you.
Thank you so much, gents. And it was a pleasure to have you all. I think, Shilpi, this is the first time we've collaborated with Lighthouse Canton, but excited to sort of engage with you more. There were some interesting points there, and good to hear some of the initiatives you're driving. And as for Sumit, we work very closely with Stan Chart, actually, across 13 markets and with the enterprise technology team. So always interesting to hear about the sort of innovation there, but totally agree on the points on keeping up the pace of innovation. Laksh, as ever, thank you very much. And Sasha, it was great to host you as well. We did actually award the DIAS platform last year for the Global Private Banking Innovation Awards, but that was through Peter Stamfley and Roland Heigley over in Switzerland. So interesting to see how it plays out in Asia. Guys, thank you so much. It was a pleasure, and as ever, we will have this recording available, so the content will be on demand. Thank you very much. Cheers.
Thank you.
And for all of you that sort of dialed in today, I'd like to say thank you very much. This was our annual Global Private Banking Innovation Summit. It's an annual briefing of private wealth leaders that we put together every year. Of course, in the midst of the pandemic, even though we're sort of looking at vaccine rollouts now, we still have to run these formats digitally. The benefit is that we can scale, and there's no sort of barriers in terms of geographical borders. At the same time, we're able to disseminate this content worldwide. We will look forward to hosting a number of smaller bespoke forums in a live format within our newsroom and studio. So do follow the Digital Banker and the Global Private Banker on LinkedIn. You can visit our website, which is digitalbankeronline.com. And we will look forward to seeing many of you at the awards gala, which is on 5th of August. We have a number of worldwide banking institutions represented there, so really interested to look at the initiatives that they've been driving out. It's not all about innovation. We are still looking at a number of traditional products as well. But to conclude, this was a great forum. We had the CIO Morning Bell in the morning. That was at 10:45 a.m. with UBS, BNP Paribas Wealth Management, Deutsche Bank, and I believe we also had a number of other sort of viewers who actually agreed that the content on that is something that is being cried out for. And this really brought together the thoughts of seminal investment strategists, those that are advising centimillionaires, multi-billionaires across the world in terms of asset allocation, portfolio, etc. So we will be keeping that content on demand for you. Thanks very much to our final panelists, just now really looking at digital innovation within the private wealth ecosystem. My name is Nirav Patel. I'm the Managing Director of Global Private Banker and the Digital Banker. Once again, thanks guys for joining us, and we will see you on the 5th of August. Take care. Bye-bye.